the worst 10 years of my life was running a hedge fund. The absolute worst 10 years.
Sounds like me with a mutual fund.
I did not sleep for 11 years. It wasn't until, and I remember the best day was in 2010. I decided to shut it down. And I remember I was using this thing. Do you remember the Ready system? It was a Goldman trading thing. Ready was a Goldman trading system. And you could press one button and it would collapse all positions.
Yeah, it's like the kill switch.
And it did it in about 20 seconds, 25 seconds. And it was the first good night's sleep I got. All right, we're already recording, so let's get it going. Welcome to The Money Runner. I'm David Nelson. This is a real treat for me today. First, it kicks off a series of interviews for the Money Runner podcast, but more importantly, my first guest, Michael Guyette, is not only a friend, Michael is one of the sharpest minds on the street. He has a legion of followers from advisors to investors, and I can tell you I'm one of them. He's an award-winning author, a chartered financial analyst, putting out cutting-edge research and commentary. His lead leg report goes right to the heart of what's driving markets. Advisors and investors both not only get an inside look into Michael's thinking, but he lays out a roadmap on how to navigate any market cycle. Finally, Michael walks the walk. He's an on-the-line portfolio manager running the ATAC rotation fund. Michael, I know I'm leaving something out, but thanks so much for joining the show. Welcome to the Money Runner.
I hope first is not the worst. Second might be the best, so maybe you have to re-invite me for second.
Say that again.
I said second is supposed to be that. First is the worst, second's the best, right? So I don't know.
No, there'll be many more of these.
We'll
I wanted you to be the first interview. One, we have a lot of history. We go way back, right back to the days of Newsmax when I was an anchor there, and I've been following your career. Really, it's been pretty extraordinary. And a couple of times we were even I was on the floor of the CNBC. You were on the panel, and there was some pushback back and forth. So it was a lot of fun. It's great to have you on my show. But let's get it right out in the open. Probably what a lot of people want to know is what happened in the last 10 days. Pretty extraordinary move in the markets. We've had a monster move off the October lows, in part driven by Fed commentary and, of course, rates coming down. So real or not, do we embrace this or do we use it as an opportunity to lighten up exposure?
All right, so there's a few parts to unpack. First of all, I had made that point many times before. This is just factual. Markets tend to crash from oversold levels, and the market was oversold. But the thing is, they can also reverse pretty aggressively, and that's why this business, as you know, is so challenging, because you can have an extreme both ways, right, when it already looks like it's pretty bombed out from a pricing perspective. So I myself was actually pretty negative entering last week based on intermarket relationships that I track. And I've been on this credit event argument for a while, which obviously has not played out on the corporate side yet. Everything rallied, large caps, small caps, treasuries. And then the following week, which is this week, we saw somewhat of a continuation, although small caps actually gave back a good amount of those gains, not fully those gains. Now, you've been in the business for a while like I have been. You and I both know that moves like this are not uncommon in bear markets, right? I mean, this is just fact. You end up having big swings both up and down. Everyone's starting to think that, wow, that was it. That's the low. And then markets do what they always do, which is that they humble everybody just at different times. Now, I still think we're in a high-risk period, broadly speaking, because I keep going back to there's still a lot of tail risk potential, meaning Japan, I think, is still problematic. The lagged effects of the fastest rate hike cycle in history are still problematic. I don't think the Fed wants to see the S&P make new highs because the wealth effect counters higher rates, which is why I think we keep seeing these periodic moments where Powell comes out and talks markets down and emphasizes we're not done hiking rates, right? Even though it sounds like it's counter to what he just said the week prior. So I think the best case scenario is that you get some momentary drift in the areas of the market which have not participated, which would go back to small caps. But the realistic scenario here is I still think we're in a bear market. I still think that this is going to be a challenged environment probably for some time. And markets do what they always do. They suck everybody in at the wrong time.
So let's talk about that. Coming into last week, I kind of felt the same way. The sentiment was abysmal in the week prior to the Fed meeting. Tactical funds and a lot of funds that I track, even internally, some of the things that we use, equity exposure was probably at the lowest levels of the year. And then even before the Fed decision on I guess it was a Wednesday, there was a little bit of a bump in the market for the first couple of days, in part because of some commentary coming out of Yellen about Treasury issuance in the fourth quarter, going to be a little less than expected. And I kind of pushed back on that because I'm looking at the fact that, we're knee deep into two wars with a possible third conflict sometime in the next couple of years. And I do the math, and that means larger deficits, more debt issuance. So how do I paint a picture of the long end of the curve, yields coming down in that environment?
So I always go back to path matters more than prediction. And actually, last week was a really good example of that. Okay, so the sentiment was abysmal, and there were a lot of people that, like me, viewed this as being a high-risk juncture. You might crash. I even said the week before, I have no problem saying it publicly. It's record. I was obviously wrong in the way it played out, but I don't believe I was wrong in the conditions. I said, I think we can see circuit breakers, right? And it didn't happen. Instead, it was the best week of the year. Okay, egg on my face. But here's the thing. If you short and you're wrong, you lose money. If you're in treasuries, you made money last week, right? Now, that's why I go back to path. So there's the argument, which I don't necessarily disagree with, about the broader headwind against treasuries because of all the spending, possible new wars coming down the pipeline, spending just increasing, who's going to buy up all these treasuries? Okay, all that's true from like a very long-term perspective. I don't disagree with that. And it is a problem. But that's not to say you can't have a couple of weeks or two where treasuries are a better way of being short equities without the risks of being short equities, right? Acting as a counter, or if anything, acting with equities like we saw, the last, 10 trading days. So the point is, we can pontificate about what treasuries are going to do from here into tomorrow and what government debt's going to look like and who's going to buy up treasuries. But in any series of weeks, I'd still rather bet on treasuries than short equities.
So let me try to put that together, because I was actually just having a conversation with some advisors across the country. And maybe the most frustrating thing for their clients, a lot of them, quote unquote, 60-40 type investors, a balanced portfolio that obviously did horribly last year, was one of the worst years for that. And so what about the thesis of maybe just protecting your portfolio? If you do the math, if you put half your money in 1 year paper, T-bills, you're going to be making more than 5%.
No.
It almost doesn't matter what you do with the other half. You can take a fair amount of risk. Even if I'm wrong, if that half is down 20% and the other side is up 5%, worst case, you're looking at probably, single digits,
right,
in terms of return. And I see that playing out. I see a lot of advisors going that route.
No, well, I'll tell you something. It's counter to my own best interest and your own best interest as people that manage money, right? I mean, I've got rules-based mutual fund and 2 ETFs. It's against our best interest, but the reality is, what's the truth? The truth is the simplest thing for most people to do is to do T-bills, is to just do and get that short duration 4.5%, 5%, and call it a day. Why deal with the anxiety? The problem is FOMO is more powerful than the Fed, and FOMO, fear of missing out, is more powerful than getting a guaranteed rate of return, right? So most people, most advisors, most individuals, the simplest answer is the right one. Just go into T-bills, do a what's called a barbell approach. If you're going to, do something, meaning go mostly T-bills and then maybe, that 15, 20% allocation, let that be the aggressive part of the portfolio. But it is amazing to me how despite all these rate hikes, they're still, people want to gamble. They want to take a chance while they still have credit card debt, while they're not advancing in their jobs and trying to be higher performers. They just want to YOLO into stocks, and they're doing it against a backdrop which I think looks pretty ugly for equities. Look, keep in mind, this is a pre-election year, right? Pre-election years are historically the strongest of the presidential cycle. I just put out a post today on X showing that when you look at it on a after inflation real return basis, 63% of the Russell 3000 index is negative after inflation. And yet people are still wanting to gamble in stocks. So, I think if you're prudent, you've got a gift now, to your point about this guaranteed rate of return. It's not a bad idea to be happy with that gift.
Markets need a catalyst to go down. And one of the things, in your research this week, it really kind of struck home because very often bad things happen in credit markets before it translates over to the stock market. And you talked about some recent commentary, and you were focused on the credit cycle. And in a recent note, you discussed the freight industry and the collapse of a bank tied to trucking loans. Let's talk about that.
Yeah, it is interesting. I mean, freight is like in a real serious recession. Okay, I mean, you are clearly seeing a very significant drop off in freight, and that's consistent with what you're seeing with the manufacturing slowdown. Now, this impacts certain banks because of loans connected to the freight industry. And freight dynamics activity tends to correlate also with upcoming recessions because it's about the real economy in terms of goods being transferred. I do think that's further to the point that we are probably still, from a macro perspective, in an environment that's going to favor some kind of a corporate credit event. Because if the economy slows down, if activity is coming to a crawl in a lot of the things which are big drivers of the economy, okay, against higher for longer and a lot of indebted companies that have to roll over their debt into higher rates with razor thin margins. Again, I go back to, I don't know why you want to gamble based on that. Right? If you're going to have a very long-term view, that's fine. All right. But I go back to path matters more than prediction, and there's all kinds of signs that there are real stresses in the real economy. It's just nobody's paying attention to it because all they're seeing is the S&P is up, the NASDAQ's up, as if they are tells on what is actually going on in the broader system, when in reality, the stock market as defined by the S&P 500 is no longer a discounting mechanism of the future. It's simply responding to fear and greed and algorithms. The reality is, I'd argue the S&P and NASDAQ are more coincident and lagging than leading. Small caps are leading. Freight is leading. Retailer stocks are leading. Utilities are leading. Lumber is leading. Gold is leading. And all those things, just from an intermediate perspective, still don't look that good.
It matters when it matters. I mean, it certainly mattered in March.
Correct.
We had a credit event. We saw it in the banks. And that begs the question, because here's the argument, and I get a lot of pushback on this because I've come out on the show and I've said the Fed is done. And I'm looking at 10-year yields that are well above where they were in March. That was in part responsible for the collapse of Silicon Valley and Signature. If there's a black swan out there, it's likely living on the balance sheet of some regional bank with a held-to-maturity portfolio that's under stress. So, one, how can the Fed hike with that as a problem? And more importantly, they've got to also support, Treasury as well, because like it or not, even though they deal with the short end of the curve and Fed funds rate, their policy and their rhetoric certainly has an effect on the long end of the curve. It certainly did last week, because after that meeting, 10-year yields cratered 30 basis points.
Yep. Yeah, and when push comes to shove, they will save treasuries and sacrifice everything else. Because if they don't save treasuries, nothing else matters. The entire system is predicated on the risk-free rate, which is treasuries. Which I really am blown away that people really don't understand that at a very core level. It's like when I say they will sacrifice stocks to save treasuries. Like, that's not my opinion. That is outright fact. And by the way, there are plenty of quantitative examples in big down days of treasuries doing well because of that logic, that reasoning, right? Treasuries are the default free option. That's what risk off is. The risk in risk off is default risk off, which is treasuries. Now, I do think that for whatever it's worth, the Fed has probably painted itself into a corner from a rhetoric perspective, right? Because you keep hammering higher for longer, higher for longer, higher for longer. Okay, well, there's a real problem with that, which is that if you keep saying that, and now you have to pivot very quickly because of some exogenous event, something happens with Japan, something happens in any other part of the world. You know, if this whole exercise with higher for longer and raising rates is about credibility, don't they lose their credibility if they have to suddenly say, you know what, we never actually meant higher for longer, we just meant higher for a little bit?
Well, they've been high for a pretty long time, man. It's been pretty rough since March of last year. But I do contend that I get the fact that they have to have the rhetoric and they have to keep that out there and keep saying that. At least they think they do. But it seems like everybody understands that there's another side of this. And I just feel like there's something that is going to force the Fed's hand, because in the end, they're the buyer of last resort. That's right. Part of their role. And their job isn't just inflation, and pricing. It is also the health of our banking system. That's certainly part of it. And that seems to be under stress. And you just brought up another one. What was the name of the bank that cratered over the trucking loans?
I'm blanking. It's been a long day. I'm blanking myself. But the most
Sacked
recent
somebody.
Right,
a bank I never even heard of. But those are the kind of things that happen. It's something you never even heard of. You weren't even thinking about it. And suddenly it becomes a big deal. So every time, it's not even just the Fed. I mean, it seems like the auctions themselves. I've been doing this for quite a while. I don't even remember when I paid attention to an auction. I never even knew they were going on. That was something for bond wonks and maybe fixed income guys. Now it's like a 5-alarm fire. When these things come out.
I'll tell you something that's funny. So as much as I post, like, I'm on calls all day long, right? So I was actually talking to an advisor who's been in the business for a while and literally just said the exact same thing you just said. And he said it a little bit earlier. He said, it used to be like, this is like a nothing burger. Like, nobody cared about these bond auctions. And now it's like, it's the main event, right? Now, I mean, what a world that we live in, that we have to worry about, demand for government treasuries. I mean, it just shows you how badly the Federal Reserve screwed up, right, with the response post-COVID, both in terms of, being late and how far they went and all the manic things we've seen since then. Now, look, I've used that line a number of times on social media, the Ernest Hemingway quote, slowly then all of a sudden. Right? So how do you go broke? Slowly then all of a sudden. Okay. Now, I said that in the context of credit spreads too, right? Why? Credit spreads widening, which is a reflection of bankruptcy risk, which, by the way, bankruptcies are increasing in the real economy. This is fact. Just like we're seeing a slowdown with freight and manufacturing, we're seeing other knock-on effects of the fastest rate hike cycle in history. Right? Credit spreads, when they widen, when junk debt starts to respond and fear starts to grip bond investors, happens very quickly. When you have a VIX spike, it happens very quickly. When credit spreads widen, it correlates to the VIX, and when it happens very quickly. So the challenge with this environment for anybody that's being overly comfortable with, going back to the start of the conversation, what happened the last 2 weeks, is that, okay, it might persist for maybe a couple more weeks more, but there's the risk that slowly then all of a sudden everything kind of unwinds, right? Because there are these hidden buildup of risks from leverage that happen from the Fed being at zero interest rates for so long and then going through the fastest rate hike cycle in history. That's not to say short the market. That's not to say things are going to hell in a handbasket. It's just to say you better be careful when you're driving now, right? And I always advocate, be very careful being overly convinced of the outcome. You can be overly convinced that it's raining. You can be overly convinced of the conditions and the weather. God knows I often am, right? Because I'm very loud in the way I communicate. But I don't know when or if the exact mile marker a crash happens. I mean, obviously not, given what happened last week. That's not to say that it's not raining still.
Let's take the other side of it for a second, because there's always two sides to a story, and there are things that are obviously working in this market.
Yep.
And much has been made about artificial intelligence, and that as being a secular growth driver, something that I've talked to quite a bit. I think there's an over reliance and an maybe too much focus on the AI heavyweights, the NVIDIAs, the Microsofts, the Alphabets, which are clearly very profitable companies and companies that I own. But I've written that some of the biggest beneficiaries are really the hundreds, if not thousands, of companies that are embracing the technology to find a way to enhance the bottom line. Could a major technology shift like this, and some of, like Marc Andreesen, have said it's bigger than the internet. So whether you believe that or not, all right, can a major technology shift be enough to maybe increase productivity enough to wipe out some of these other negative things that are happening?
But I mean, Marc Andreesen's obviously a brilliant investor, but I'm pretty sure he invested in Clubhouse, and there was an insane valuation. Maybe I'm wrong on that. That app, the social audio app, that would it's now worth what? I mean, I don't even know. So my point is okay, somebody can say that, doesn't mean they're right. I don't care how successful somebody is. Nobody knows what the future holds. I don't care how wealthy anybody is, right? We all, independent of our net worth, have no idea what tomorrow brings. But these statements obviously get traction. Okay, so I don't disagree with any of that. I've noted that point before. There is this disconnect in what you're alluding to, which is AI is supposed to be this incredible next industrial revolution. I think we can all agree that AI is not supposed to be inflationary. It's supposed to be quite the opposite, disinflationary. And yet long duration yields keep rising. And yet inflation expectations further out in time are not really responding off of the technological shifting of inflation that should come from AI permeating every single part of our world, right? So I'm not saying that it's not going to be the case. What I'm saying is that you can't inherently argue that AI is going to take over everything, that AI is it, and then it not be reflected in every other asset class that should be impacted by
but let me push
AI.
back for a second. Couldn't it be that AI is, maybe it would be worse? Maybe it would be worse than it is now without a new technology like this. I mean, I look at a company, I'll give you an example. A company like John Deere, certainly not a technology company. It's an old-line tractor company. Yet they're large combines, and I have farmer friends that are using this. The AI technology is now part of the machines, and they're looking down at the ground, and they're determining, the cameras are looking down and determining the difference between a weed and a crop. And it's only spraying the weeds. One, that's got to be deflationary in the sense that it's certainly less insecticide, certainly more healthy. So the crop maybe can be sold at a higher price. And probably the machinery will cost more, and certainly a benefit to deer and the people that use it. Why can't things like that be a deflationary force, or a force for good, however you want to view it, and maybe keeping it from getting worse than it would have been?
Yeah, no. I think that's valid, and actually that's very consistent with why I push back against what I call the swiggly traders, who look at long duration yields and interest rates and who say, well, we're going to go back to the 13% level from the 1980s. Okay, the problem with all these arguments around, interest rates historically, should be much higher because look at the average over the last number of decades or centuries, is technology, right? Because exactly to your point, that only gets better. That's inherently disinflationary, which means the average interest rate should be lower because of the advancements of things just like you just mentioned. So, and that's why I go back to what's interesting in treasuries here is to me fascinating in the context of the AI debate discussion. Because if AI is going to be that big of a deal, it sounds like 5% on a treasury is could be a generational buy, no different than what happened in the early 80s, because of the technology component forcing the average rate lower, the disinflation effects. That's not a very popular opinion because everyone now is just saying, well, we went through ZERP and now we have to go to 13, 14, 15% like the 80s. it's like they forgot the efficiency that the entire system has had.
Yeah, but to that point, in the 1980s, the debt to GDP was a different figure than it is today.
That's fair. No, that's fair. Unequivocally, sure.
So it's not apples. It's not apples to apples. And I'm not saying that it can save the world.
Right.
But maybe things would be a lot worse than they are. Because I go along with your thesis. I have very difficult time believing that the long end of the curve is going to push higher, just simply because if I'm a bond investor, I want some food on my plate.
Sure.
You're asking me to extend duration in a world where inflation has not been necessarily tamed yet, and you're just issuing an awful lot of paper. Right. So why should I be the last one? And some of the traditional buyers out there are not stepping up. We saw that in the auction yesterday.
Yeah, and so it's interesting back and forth. Because I can push back further because that relates to a narrative that's out there that all this money printing means inflation is going to keep on rising. There's this Cantillon effect, right? I mean, the more the government spends, the more likely it gets funneled to only a select number of economic actors. And all that money that the government's spending then isn't inflationary because it sits, right, among the very wealthy. So the effect of that is a widening wealth gap. A widening wealth gap is also disinflationary. So there's a lot of, I think the point is that there's a lot of fascinating, complicated dynamics with which all this plays out. Regardless, going back to the original question about, the AI move and sort of the broader, idea that, look at the bright side, maybe things recover. I don't disagree with any of that. You always have to do scenario analysis, right? Whenever you're doing any kind of portfolio construction outside of a rules-based approach like what I do with my funds. I still believe the base case should be, hard landing. And the base case probably is this will surprise everybody negatively in terms of what the Fed has done. If that's wrong, yeah, then you know what? I can't wait to get fed, even though I'm fasting, from my AI, powered waiter.
Let's look at something, that a lot of people are thinking about right now. And it's, what do we do between now and the end of the year? You've been doing this for a while. And traditionally, the end of the year, we're told we get this, kind of Santa Claus rally. And maybe this is the beginning of it, what we saw today, pretty sharp move higher. Certainly for the last couple of weeks. The November to December is supposed to be a good time. So far, that's holding up. But what about the things that haven't worked? Last year, right. You couldn't get out. You couldn't sell enough Microsoft, to get out because it had been down all year. Everybody was dumping it. So small caps are kind of the laggard this year. Even mid caps to a certain extent. A lot of areas of the market. You just mentioned 63% of the stocks were negative on the year. Is it too early to start buying those names? Are they just going to get flushed out in the next couple of weeks and stay with what you got, and then maybe look in January?
I mean, I wish I could tell you in January the answer to that, so I can come back and tell you what actually happens. I think. Look, I've been cynical on the seasonality argument, which is put out there, and seasonality, to your point, didn't work last year, right? It was the fifth worst December in history for the S&P. There was no Santa Claus rally from that perspective. Now, having said that, maybe I'm wrong about the seasonality. Maybe it is kicking in, but if it kicks in, it should really kick in from small caps. It should be a breadth improvement. Again, it's not impossible. The problem is if you're going to argue seasonality here is bullish for stocks, you should then see the right types of risk-on relationships leading that. So what does that mean? You should see utilities weak relative to the S&P, because seasonality-wise, you should not see utilities be a market leader. Now, they've weakened actually quite a bit just the last 3-4 trading days, to my surprise, by the way. You should see gold weak and lumber strong, because that would suggest more risk-on sentiment is there. A little bit of weakness there, unclear how much that sticks. But my point is, if you're going to argue for seasonality, you have to look at the seasonality of the leading indicators that say risk-seeking behavior is kicking back in. It could be the case. I don't disagree. I just don't believe it's likely, right? And I think because everybody and their mother is talking about seasonality, I get nervous just intellectually when I hear everybody saying the same thing, right? As if it's a given. Now, for me, it doesn't matter for my funds, right? My funds will do whatever they do, rules-based, they rotate, independent of anything. It's not discretionary in that sense. But I would just caution anybody to think, if everybody's thinking like everybody else about seasonality, maybe winter is coming in a wrong way.
I want to shift gears for a second because it's going to drive markets for the next 12 months. We're coming up on an election cycle, or we've actually already probably knee deep into an election cycle, less than a year to the next election. I don't see anything changing on either side of the aisle in terms of getting more fiscally responsible, which is in part what the market is reacting to. I mean, I just watched the Republican debate, and no less than at least half the candidates were talking about massive military spending increases. They were talking about taking the U.S. Navy from, I think, 290 ships up to 350 ships.
Yeah.
That's a lot of money. All right. So even if you cut all that stuff in half, and the other side of the aisle is doing that as well. And I'm a military, I'm a hawk. I've got family in the military. I believe we have to defend ourselves, but I feel like we're writing checks that we can't pay for, and that's one way or the other has to play out in financial instruments, in particular the bond market. If we continue on that course, how high could yields go? What would be your bearish case on that?
Well, look, okay, so debt becomes deflationary when you cannot issue more of it. Right? Debt becomes
Explain
deflationary.
That. I want to understand that.
So I think this is like the whole discussion around debt being inflationary or deflationary is a function of, can you roll it going forward? Right? Is there somebody that you can roll and kick that can down the line that you roll it to? So you can keep on increasing debt and it's inflationary, but only to the point where somebody's willing to lend you to keep that game going, right? And, you can argue that's what the Fed's role is to do. Okay, well, here's the problem. The Fed wants to get out of the balance sheet game. I don't think they're ever going to be able to fully do so. But let's say under that scenario, the defense spending really ratchets up. Is the Fed going to be able to absorb that? Because if the Fed cannot absorb that and foreign holders of treasuries are not buying, then yeah, you could have a real disruption further to treasury yields. Now, the problem is, if that happens, everybody else is more screwed than the U.S. government. This is the other part of the discussion which I think is missed. If you end up having a real super spike in treasury yields, you know how you bring that back down? Through fear that the government will tax us more to pay for their profligate spending. Now, we can debate whether there's actual appetite for that, but the point is, the U.S. government will always be able to pay off its bills, whether it's from the Federal Reserve printing it or from them taking it. Which means we would be in much deeper trouble. You'd see spreads widen at such a substantial clip at the expense of saving treasuries so that they can fund the army.
I'm trying to think of where I want to go with that, and I find it kind of concerning. And you're painting
it's all concerning, David. On X, I say it in a joking way with all caps. People know the word I say, right? It starts with F and ends with uct, right? But and I say kind of in a comedic way, but I don't know how people don't see what's happening and don't say wow, we really are in a nasty setup. I mean, with government debt and with the way that people think about and interact with each other and the way we constantly are tearing at each other. I mean, it's like, I hate to be bearish on humanity. I hate to say that, but it's like, I don't know. I often wonder about these kind of very long-term secular trends.
I'm going to push back on that, okay? Because when you cross over to that side, because the one thing that we've learned over the last 30, 40 years is that as we dig deeper and deeper holes, as humanity, we have the ability to repair and recognize that something's wrong. And we haven't gotten to that point, but we get to a point where suddenly we realized we've got to fix it. All right, we've got to do something to fix it. We had to do something with the banks after 2008. They were a mess going into 2008. I'm not saying that they're good now, but they're certainly in better shape than they were in 2007. So, I'm kind of, I guess, the eternal optimist. I'm a long only guy. For the most part.
As am I.
With the money that I run, we were talking earlier, and I talked about running a hedge fund. It was the worst 10 years of my life. I never want to do that again. So when I'm bearish, I'm repositioned, but I'm probably still in the game. Maybe I'm more defensive. But you bring up a lot of food for thought. But there's a lot more to Michael Gayed than I think people really understand. You're obviously a brilliant market strategist, and you're out there. And plus, you're an on-the-line portfolio manager, and most aren't. A lot of people talk this game, but until you're actually running money, other people's money, and it's a lot different than when you're running your own money. When you're running your own money, you only answer to yourself.
Yeah.
When you're running other people's money, the shit hits the fan really quickly. And you talk to a lot of people in this game. You talk to a lot of advisors. A lot of the advisors that are under my tutelage here at Bell Point follow what you write. How do you keep them in the game, and how do you position them on each incremental day or each incremental week with all the chaos that they're seeing on a day in, day out basis?
And just to respond to that point, I remember, so my father ran a hedge fund himself, right? And this is from 2000 to 2008. He had a hedge fund, wasn't particularly big, right? And he had some clients in the early stages like Stanley Druckenmiller and a couple of other big names. But when I graduated and I joined the family firm, I remember, he was in his office. He had a small office, just him. He had like 8 screens. He was one of those kind of traders. And, I was a young guy, right? I was in my early 20s. And he said to me, wait till you're in my seat. Wait till you get to feel that pressure. Wait till you see and feel that anxiety daily, right? And I get it now. And I get it from the perspective maybe slightly different from his, in that I always use that line, there's no gurus, only cycles. Now, I launched 3 funds. They're designed to play the flight to safety trade in treasuries, which has not been there for the last 2 years. I've gone through, in these funds, a nasty drawdown. People have a hard time differentiating between me as an analyst or researcher and me as a portfolio manager of rules-based funds that would run the exact same way if I died tomorrow. But you know what? Even though those are rules-based funds and I should be detached from the outcome, I have anxiety every single day, right? And I have to keep on getting out there and waiting for the light to change, right? And unless you are in the business doing that, having the skin in the game, and I have skin in the game because it costs a lot of money, as you know, to have an ETF open and have a mutual fund open, and you can't control the outcome because it's a function of the environment that you're in. Unless you know what that's like, you can't possibly understand how difficult the business of managing other people's money is. To your point, it is nowhere near like managing your own. Nowhere near like it as a business. Now, I am an optimist too, but in a different way. I'm an optimist in the idea that conditions change. I'm an optimist in the idea that nothing's forever, everything's just a moment in time. So as much as I myself have gone through that pain, that anxiety, I'm optimistic that it will end. And because I can't control the value of my portfolios, just like you can't and nobody can. I mean, that's the thing about this business. Nobody can tell me they know exactly what their portfolio is going to look like by end of year, unless they happen to be in T-bills. And even that is nuanced, because then what's the after inflation rate of return, right? But unless you recognize that you can't control the value of your portfolio and that you can do more with your time, you can't be efficient. And in my case, my form of efficiency in terms of what I can control is content analysis, talking to advisors, talking to individuals, trying to get them to be aware of what I believe in, which is identifying the conditions, right? And I view myself very much like a weatherman. And it's so funny to me. People seem to rag on weathermen all the time, meteorologists. Oh, they're always wrong. They're the most accurate in their profession. in the business of forecasting the future. Meteorologists have been proven to be the most accurate, and yet you're vilified for saying all you're trying to do is tell people it's raining. Right? I mean, it is a wild dynamic, and I just want to emphasize that point. This is not a business, as you know, David, for everyone. Right? Everyone thinks they can be a PM. Everybody thinks they can be, this manager that's raising all kinds of money and trading and making all this, great returns and living that life. It is difficult. This is perhaps one of the hardest careers you can imagine because there's so little in your control, except your identification of the weather and in your communication of the conditions.
You mentioned your dad, and it made me think of my own dad and so kind of how he drove me. I didn't realize it. So your dad was in the business, running a hedge fund. Did he actually develop? You developed a whole style based on intermarket theory.
Yeah.
Is he the one who set you on that path? Did you kind of know even beforehand, before college, maybe, that this was the direction you wanted to go?
Yeah, I mean, so I always grew up thinking I'd be in this career. When he passed away, I always thought I'd take over the family business and grow it, but I was not of age to take it over in 2008. My father passed, Lehman Brothers. It was the break in my life, right? That as far as where I thought my life would go. But I'm sure you've seen that meme, right? It's like people's perception of where they're going to be. The end point is a straight line, is their perception. But in reality, to get to the end is like all kinds of squiggle lines and different, ways to ultimately get there, and it takes longer and it's harder than you think. So yes, I mean, a lot of my father's thinking and framework and cynicism I still have inside me. The difference is he didn't have a rules-based approach. He was discretionary in the way he was trading. It was his book. I think it was page 311, 314. It was one little section in his book, Intermarket Analysis and Investing, where the section is titled "Utilities Lead the Stock Market." And I saw that, and I tested it, and that became the genesis of the 2014 Dow Award paper, an intermarket approach to beta rotation, which looked at the utility sector as a leading indicator, became one of the risk-off indicators for my mutual fund, one of the risk-off indicator for my JoJo bond ETF. So the influence is there, but I'll tell you something. It really does haunt me to this day. All those years ago when I remember just seeing him and I didn't understand. I was like a lot of these guys that you see on social media who are beating their chest. Oh, I can beat the market. I'm awesome. I know all this stuff. I was like that too. It's like that great Oscar Wilde quote. I'm not young enough to know everything. Right? It's literally like that. I mean, I think
remember that one.
Through with that, right? So but my point is like, and I've been humbled so many times in cycles to know that that's not the way this business works. So and from that perspective, I think my father's words ring true. You can't understand what this business is like unless you're actually sitting in that seat.
Look at before we come up on a hard out here, because we're going to run out of time. I want to make sure I explore this because a lot of this call was admittedly fairly bearish and looking at the downside of the market, but things change.
Yeah.
And I guess what our listeners want to know, at least my listeners want to know, and maybe even your own, even the people that follow you, what is it going to take to bring Michael Gayed out and go, you know what, the sun is shining. This is a better environment. What are you watching for, and how would that translate into a change in your portfolios?
Yeah, no, for sure. Okay. So I go back to all I'm doing is reading into market relationships and trying to see what is the market internally saying and then communicate that, right? Okay, so what would turn me optimistic is if you had some kind of persistent weakness in utilities, defensive sector, if you had persistent strength in lumber, risk on signal, if you had persistent uptrend movement in terms of being above the 200-day moving average, because that also is a risk on indicator, if you had the right stuff outperforming, retailer stocks, because that's a sign of the consumer, financials outperforming, because that's a sign of health for the financial sector and credit creation. You need to have the right things working in terms of what's leading and what's lagging, which is the whole idea of the lead lag report, right? It's not based on my opinion. It's based on what the market itself is telling me based on these relative movements right? That you can back test and quantify as to whether or not they're telling you if it's sunny or not, right? Now, maybe that happens. And believe me, I have no problem suddenly flip-flopping because that's what you're supposed to do.
I've seen you do it.
I mean, I've done it for
I've seen you
years.
do it in the past.
You're supposed to flip-flop. When conditions change, you change, right? I have no problem screaming melt up if those areas are showing persistent strength. But the thing is, they're not, right? Now, again, maybe they do, but everything for me is dictated by these relationships that I could backtest, as opposed to patterns and formations and things related to options and zero DT. Like, none of this stuff which people refer to as leading indicators are ever backtested and you can ever prove works. At least when I try to have a viewpoint on what the conditions are saying, I know what the history says. And right now, nothing, well, I shouldn't say nothing. Right now, it's very early to be convinced that it's sunny. Maybe it is, right? Every storm ends, right? But until it's really shining, hard, I'm going to still say, be cautious, slow down. At least don't be at the speed limit.
Awesome stuff, Michael. As always, you're one of the best. It's why I follow you. You've been a friend for a long time. I know my listeners are going to like this. Anything we left out that you need to get out there that you need to talk about? Have we covered it all? Have we covered enough?
No, I mean, look, Dave, I've known you for a long time. We've had drinks a couple of times. I can't do that now because of the fasting again. But you are also one of the greats, and I do appreciate your depth of knowledge and your kindness. I will tell you, I have been disappointed by humanity in the way that some people respond to not just me, but people I've even interviewed, right, that just say things behind your back. But you are one of the good ones, and I think for anybody that's listening, support David, follow him on social media also, and I would stress everybody: don't be convinced of the outcome, be convinced of the conditions, and
Awesome.
objectively look at the conditions. That is the key.
Michael, thank you. First, tell everyone where they can follow you, and how do you sign up for the League Lag Report?
You're not going to follow me on any places that have the phase. First of all, just because of what I've been going through. No, but on X, on Threads, Instagram, YouTube, at Lead Lag Report is the consistent handle on all those. On Substack as well, and of course, leadlagreport.com. Lead Lag Report is a separate endeavor, separate from my rules-based funds. I do everything I can to communicate openly, and just like everybody else, I'm right a lot, I'm wrong a lot. No amount of intelligence can increase the clarity of one's crystal ball. But there's one thing that I am for sure, which is consistent in process, even if the outcome is different.
Well said. Michael Gayed. Michael Gayed, author of the Lead Lag Report and portfolio manager for the ATAC Rotation Fund. Michael, thanks so much for being with us. We'll be right back.
You're the man, Dave.
Michael said it. This is hard work. Investing and protecting capital means taking a lot of time, effort, and research to get it right. Would you want anything less from your doctor? I'm probably in the camp where the glass is half full, but Michael gave us some really important data to consider before investing that next dollar. Today's interview was the first of many, but in the meantime, if you like today's pod, hit subscribe. And as always, comments are welcome. Let us know what you think. Thanks for joining. I'm David Nelson.